We're going to be talking about the first step to investing, and that comes by understanding two concepts: investing and speculation. I believe that both of them are somewhat connected. Like a coin, every coin has three sides: the heads, the tail, and the edge. On one side we call investing, and the other side we call speculation. You and I have to stand on the edge of the coin. Standing on the edge enables us see and understand what both sides offer. Now there's a thin line that separates investing and speculating. I call it the razor's edge. It's so thin in most cases, it's difficult to even recognize. Now, how do you create a level of success that allows you to stand out from the market? I believe it comes by having a set of guiding philosophy. That is my opinion. I'm not suggesting that it's entirely right, but it applies and works for me. Investing is simply the process of putting money out to get more money back in return. And to do that, there are three questions you really want answered. The first is, when am I going to get my principal back? The money I put out, when am I going to get it back? Number two, what is the degree of certainty that I'm going to get it back? And number three, what do I get in return for taking that risk? If you can answer those three questions, we call that investing. If you can't, we say that you're somewhat perhaps speculating. So with investing and speculation, what separates both of them is the word risk and certainty. To the degree that you have high certainty that you'll get your money back, get your principal back, you get your return back, and you know when, we see that as investing. And where there's high certainty, we want to minimize the risk. We want to be able to quantify that risk. On one side, that's investing. Now on the other side, if the degree of risk is higher, meaning you can't really say with some degree of precision or certainty that you're going to get your money back, and you can't say when, and you can't say perhaps what you're going to get in return, then we call that speculation. So with speculation, you have higher risk and you have less certainty, and that's the difference. Now let's talk about digital assets and how you can use that knowledge to invest. In principle, I'm going to be referring to digital assets, but I like to just say this: principles are fundamental. You can apply them to any area of investing. You can even apply them to any area of life if you use principles, if you use fundamental principles. Now, I think what makes it easy for you to sustain the degree of success that you create in investing comes down to a few principles. I want to talk about perhaps 4 of them as a basis upon which you can perhaps start to create your financial career, or perhaps improve your financial results. The first is philosophy. Now I know that sounds a little bit archaic and sounds a bit old and boring, but I'd like to ask you a question. Think about this. If I came up to you and I said that I would like you to invest in a company, and this company would pay you 10% return. This company has been in existence and has been trading for about 10-15 years, and every year, as the books and records will show from their annual reports and financial statements, that every single year they've made a profit and their shareholders have received the dividends promised. And I said, you get 10%. And I said, that's one option. Or that I could give you an opportunity to invest in a different company. This is a new company. It'll pay you 25% return. However, it's still a fairly new company. They've only been in existence for about 12 months. And because they're still fairly young, there's some uncertainty about whether they would keep to their promises. Now, which of the two would you choose? It's not a trick question. If you chose the first, then what you're telling me is that you have an attitude towards risk aversion, which is you're a little bit more prone towards taking less risk. If on the other hand you decided you were going to choose the second option, then again, there's nothing wrong with that. What that simply means is that you have perhaps more tolerance to risk. Your level of risk aversion is different from the first. Now, what you've just given me is an insight to your philosophy. Now, if you chose the first and I came and I tried to persuade you and kind of guide you into choosing the second option, you would be deviating from your philosophy, and interestingly, that is where most people lose money, where they move away from their values, their principles, and their priorities. So the first thing you need as an investor is a philosophy. And a philosophy comes in two ways, and it does two things for you. Number one, it's like a set of guidance system. Internally, it helps you think. Now, this is really interesting and really important. The quality of your life today is really a reflection and a result of the quality of your thinking. The quality of your thinking have created the decisions you've made. Your decisions, when made, have led to some actions you've taken, and those actions have created your results. So, philosophies guide your thinking process. They help you process ideas and information and sort out which is right and what perhaps is inconsistent with your personality and your values, so that you can discard them. So they help you internally. But your philosophy also helps you externally, because they serve as a lens by which you see the market. Now, this is interesting. The way you make money in investing is not simply by perhaps trying to predict what's going to happen or by relying on luck. You make money in investing by betting against the consensus, by betting against the market. And to do that, you need to be a good thinker. You need to identify where the market has made mistakes, where there are inefficiencies in the market, and take advantage of those inefficiencies. That's how you make money in investing. And it's your philosophy that enables you to understand how the market works. So your philosophy helps you internally, but it helps you externally. Now, one of the first things that I had to do when I started investing was try and understand and define my philosophies. And sometimes it takes a while. Sometimes you're better off perhaps studying other great investors and understanding their philosophies and seeing if their philosophies, because they've been defined, seeing if those philosophies accord with your values, your personality, and perhaps your character. Now, once you've defined your philosophy, or in this case, if you've borrowed a philosophy, what you must do then is blend your philosophy with who you are, your personality, your attitude, your vision, your purpose. When you combine both, you have a solid foundation upon which to build on. So number one is you need a philosophy. Now, one of my interesting foundations to my philosophy is a concept that says rule number one of investing is never lose money. Rule number two is never forget. Rule number one. Now, you must forgive me, that's borrowed. It's not Mensah's, it's Warren Buffett's. And he's considered to be one of the greatest investors of all times. And that value system serves as a guidance. Now, that doesn't mean I don't lose money or I don't expect to lose. It puts me in a position whereby I become very cautious. And therefore, my philosophies come from the point of view of managing risk. So my priority is really risk control rather than trying to make a lot of money. If you don't lose money, and you follow that philosophy of focusing on not losing, it's a lot easier to do well. If your focus is on the other end, which is I want to make a lot of money, there's a high possibility that you will make a lot of mistakes. Interestingly, one of the interesting questions that I tend to ask people if there's an investment opportunity is this question: what is the downside? If we take on this opportunity, what is the downside? What can't we see? And that's the question you have to ask yourself. Let me move on. You have your philosophy. What I had to do was document those philosophies in writing, and they became principles. Principles that I could refer back to, principles that I could look at regularly. You see, here is what's important. You and I will make decisions every single day. But the bluntest pencil is better than the best mind. You can't remember everything. We have between 70 and 80,000 thoughts every single day. And unfortunately, most people are making investment decisions emotively rather than rationally. They're not thinking. So I write down my philosophies as principles so that if I have to make an investment decision, I'm not relying on gut and how I feel, which I have to say is something you must control. I'm not relying on experience alone. I go back to first principles. And I use those principles as a checklist. And I ask myself the first question: does this opportunity contradict, or is it in line, and is it consistent with my first principle? If the answer is yes, I move to the next. And I take down this checklist. And if the answer is overwhelmingly yes, then it's a good incentive for me now to consider it. Whenever the answer is no, I don't have to rationalize. I don't have to justify. It's an indication that I should walk away from the investment. And that is what you have to do. Now, number one, you need a philosophy. The second thing you need is an approach, a strategy of how you actually create success and how you do well. And let me put it in an interesting way so you understand. The art of constructing a thoughtful portfolio is the key to success in investing. I'm going to say that again. The art of understanding how to construct and design a thoughtful portfolio construction is the key to success in investing. It's not how many assets you have. It's how have you intelligently constructed your portfolio. And this is the most important reason. We have what's called cycles, market cycles. The market goes up, the market comes down. Whenever the market comes down, it's called a correction, which I have to say is a euphemism for when you lose a lot of money. Now, if you haven't experienced that, then I want you to brace yourself, because if you're not prepared for it, it's going to shock you. So the key to success in investing is not how well you do when the market is doing well. Peter Lynch used to say, buy a business that is so good that anyone can run it, even an idiot, because sooner or later, one will. And here is the point. In an up market, what's called a bull market, most people confuse the bull market or the up market for intelligence. They're not the same. You could understand the difference. In a down market, that's where we get to see who the good investors are. And in some cases, depending on the asset class you invest in, that down market or bear market could be for a few years, could be for a few months, could be even for a decade. The question is, how many can hold on? And the key to constructing a portfolio is simply so that even though the market cycles, that irrespective of the market position, you're doing well on average. And I mean, I'm not saying on average in terms of average in investing. I mean, when you take into account the entire cycle, you're doing very well. And that comes because you've intelligently selected, constructed and designed a portfolio that can withstand the downside, but also maximize the upside. Number three, assuming you've constructed your portfolio and you've applied intelligent asset allocation, asset selection, and diversification. The third thing you need is a strategy whereby you then execute. Take action. You have a plan. How do I execute on the plan? How do I put it to work? And how do I do it intelligently? Tactics. But also, whilst I'm taking those actions, how do I adjust to the cyclic nature of the market? How do I adjust to the almost varying nature and the degree of randomness that I experience in the market, especially in digital asset investing? So you need an execution strategy. And number 4, and this is something that I see rarely, you need a simple process and principle, a method of evaluating how well you're doing. Now think about this. If you're going to be an investor, then in principle you have to become what's called a portfolio manager. Now you might manage that portfolio or portfolios yourself, or you might have a team of people who support you. But in principle, you guys become portfolio managers, and that simply means you've selected the assets, you've put those assets in the portfolio, you've managed them. After a certain period, you need to sit down and ask yourself, what did I do right? Now, Brian Tracy has something that I love, something he said that I love. He said, at the end of every day, ask yourself 2 questions. What did I do right? And what could I have done differently? I think those are powerful words. What did I do right? The reason you want to find out what you've done right is because, you see, you want to reward yourself for doing things right, but more importantly, you want to keep doing what you're doing well. Repetition, repetition, repetition. There's no need to try and reinvent the wheel. A wise man once said, I'm no genius, but I'm smart around certain areas, and I stay around those areas. Now, his name was Mr. Watson. You and I have to find out what we're doing well. You see, Tom Watson understood what he did well, and that's all he focused on doing. But you want to understand and recognize what you could have done differently. And that is so important. Why? So that you can course correct. You can make changes to your portfolio. You can make changes to your team structure. You can make changes to your strategy, and you can course correct. 4 simple approaches. Now, those 4 approaches separate investing from speculating. If you have all 4, and if you do it intelligently, then you're investing. If you're not following those 4 steps, then you're speculating. In that case, you're simply relying on hope. Nothing wrong with that. But it's just important you understand what you're doing. I hope that's been useful. We're going to stop for today. And in the next session, we're going to take it a little bit further. We're going to go into how you can start to create the results you want, irrespective of the asset class you're invested in. And I'm going to show you how perhaps I've used some ideas and I'm applying those ideas in my portfolio and the results I'm getting. I hope you enjoy it. I wish you all the best.